There's another topic as far as that's based on a short-term adverse effect, and that comes from utilization rates on credit cards and revolving accounts. That's the second point we're going to discuss, and for that, Jason's going to talk about that with you.
Yeah, so revolving debts are a little different than installment loans. John talked a little bit about the installment loans. All you can do on that is just pay those on time. Don't go 30 days late on that. But with revolving debts, so those would be your credit cards or any kind of line of credit that you may have with a bank or anything like that. Those are going to score heavily on your utilization rate. So what that is just for easy math. Let's say you have a credit card with $1,000 limit on it. If you have used $500 of that, you are at a 50% utilization rate. So you've used half of your available line of credit. When you do this on revolving debts, they are scored a little differently than installment loans, so they take into account that utilization rate as well. So the general rule of thumb, what you want to do is keep that utilization rate below 30%. As the utilization rate gets higher, your score is going to get lower. Now, the good news is it's not like missing a payment. So if you have a credit card that is maxed out, close to maxed out, once you pay that down, you're going to see the score come up immediately, or as soon as that credit card reports to the credit bureaus. So that's something to keep in mind. If you have a lot of revolving debt, you want to keep that utilization rate as low as possible for the best effect on your credit scores.